Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Dennis Dick, and we have Tim Anderson on the line. He is from TJ Investments. He has a view of the floor. Tim, a lot of different things, a lot of different rumors, a lot of things were said and done on Monday and Tuesday. Could you please just walk us through your vision of what you saw take place on the floor of the New York Stock Exchange?
Sure. I'm not really sure what all the rumors were or all the stories were, but I know there was a tremendous amount of misinformation about what went on and why on the opening Monday morning, and then on the last hour and maybe just the last 15 minutes on Tuesday, because it was very unusual, and it certainly skewed the charts a lot for anybody that's looking at price points from Monday's lows or Tuesday's close.
Okay. Well, first,
Monday.
start with
Okay,
Monday.
we were down 1,000 points, 1,000 Dow points on Monday, a little bit more than that. We never should have opened down that far. I don't know what the right number would be. Maybe it's 800 points. I'm just kind of throwing a dart at that. Okay, there's no doubt that we were going to open down. Futures were way down. I mean, we were looking down maybe 600 at 8 o'clock, 8:15. But what happened is there's this thing called Rule 48, where in very volatile markets, the exchange makes a decision that I'll call them modern-day specialists. I guess they're really called direct market makers. They can open stocks without an indication. Now, usually if a stock is going to open more than a certain percentage from the last sale, on a one-off basis, it will be indicated. Okay, so that people can respond intelligently. Let's say the last sale is 50. If there's news in the stock and it's going to open down, 42 to 45, it will be indicated. And what that does is that allows a lot of people to kind of get a heads up. Hey, XYZ, you really cared about this last week. It might be down 5 or 6 points. Oh, okay, thank you very much. Let me talk to my PM. I'll be right back. Maybe that guy comes back with an order to buy stock with a high of 47. Okay, so when you're going to have extreme volatility all across the floor, the exchange says, you know what, if we do this, if we indicate every stock that's going to open beyond what our parameter is that would normally require us to indicate it, it's going to be hundreds of stocks, and a lot of stocks won't open until 10 o'clock, 10:15. And, of course, what they're really concerned about is a lot of volume will start trading away.
Oh.
And they don't want the volume to trade away. So they would rather open the stocks, get the stocks open as soon as possible, and then let everybody react. But it causes extreme, aberrant price points that probably really shouldn't exist. For instance, General Electric opened below 20. Traded 23-ish, most of the 22, 23, most of the rest of the day. If General Electric had been indicated below 20, it probably wouldn't have opened below 21. But then there were some other examples, like where stocks opened down and then traded significantly lower in the first few minutes or first minute and a half, like J.P. Morgan opened at, I believe, 57, down 4, and then traded down to 50. Verizon opened maybe 43-ish. You guys have the charts in front of me. I don't.
Yep.
You have the charts in front of you. I don't right now. Verizon opened maybe at 43-ish. I think it traded down close to 38.
Yeah.
This is Verizon, a company with a 6% yield.
Yeah.
Okay? So, this down 1,000 point, down 1,100 point, that kind of, that was a little artificial. I mean, did those prices really exist? Was any of that taken off the tape? No, it was not. Those are good prices. Those are good reports. People sold stock at those prices. People bought stock at those prices.
So, Tim, just to clarify here, and I think you're kind of saying the same thing that I was saying, I think it was a liquidity issue, and probably a lot of the lack of liquidity was there because we didn't have those opening indications. Is that what you were saying?
That's correct. Now, on the other hand, You could look at Apple Computer, which does not trade on the New York Stock
Yeah.
Exchange, trades on NASDAQ, and
Yeah.
opened, I can't remember what the last sale was, it opened at 92. Was that down 25 points? I think it might have been. And it's not like it opened on 92 on
15, but yeah.
nothing. It's
Yeah.
not like it opened there on no volume at all. I think it opened at, 8 million shares traded in the first 30 seconds.
Yeah.
Now, there was something going on with some of these stocks that had a lot of exposure to China also, and I'm not really sure what it was, but if you looked at Alibaba, that opened at an extreme discount to the last sale also on a lot of volume. Lot of volume. So I think there was a liquidity event with some big account somewhere that maybe, who knows, it could have been a number of different situations. I mean, I have thought that the market was... Go ahead.
And I just want to ask you, because, being a floor trader in that, I've said for quite a while, I have a concern that, we don't have the floor traders we used to. We don't have this diverse liquidity pool that we used to. We have a lot of high-frequency traders providing the liquidity now. And we know when there's price uncertainty, they back off a little bit. And because we don't have, so many floor traders and we don't have other liquidity providers there, we're kind of dependent on these high-frequency traders. When they back off a little bit, is that when we get these huge, liquidity problems?
Well, you're definitely on the right track, but I'm going to give you just a slightly different spin on it. Okay.
Sure. Perfect.
Unlike most of the floors in Chicago, okay, there were never really that many floor traders on the New York Stock Exchange.
Okay.
Okay. There were maybe 6 or 8 guys that had the license to trade for their own account down there on the floor.
Okay.
But where there was the liquidity, where the buying power really lied back in the day, was with the specialist firms.
Right.
Okay?
Exactly.
You had specialist firms you had some undercapitalized specialist firms, but then you had some specialist firms, the significant ones, that would say, J.P. Morgan, it's going to open down, I'll buy $1 million down 5s. Okay?
Yeah.
And if it went down another $1, it went down another $1. If it went down, most times they do well with it. Once in a while, they'd get clipped. I happen to know that the direct market maker did buy stock at 50, at 57 on the opening in J.P. Morgan. And the way the world works today, all of those firms that are modern-day specialists are high-frequency firms. It goes into their position, and whether the stock moves with them or against them, they immediately then become a seller. And they just become a seller at a 20% or a 10%, whatever their allowed volume to sell stock is, and they have to yield to orders, and there's rules and everything. But the algo figures all that out, and the irony of it is they probably sold stock all the way down to towards 50, whether or not they got out of it before then or not. I don't really know. I don't know how much volume traded between 50 and 57. And then when it rebounded on the way back up, they had to sell stock also because they have to provide some liquidity. Believe me, these guys provide a tiny, tiny fraction of what the specialist firms used to back in the day.
And not only that, Tim, just to add on that point, is it's the speed of it all. Because if you think back in the day, if you had the stock that was going to gap down, you'd have, some time for that, specialist back in the day to put that print together. And he could call around and say, hey, look, I got J.P. Morgan going to go down 2 points. Has somebody got some counter interest? Well, this thing trades down there in 5 seconds. Is not even any time at all for traders to come in and say, hey, I'll buy J.P. Morgan at 51 or 52 or 53, and it won't trade 50 then. So if they slowed the markets down just a little bit there, at least off the open, stuff like this wouldn't happen.
That's right.
We're on the line with Tim Anderson. He's managing director of TJM Investments. He's giving us a direct account of what took place on the floor Monday morning. And now let's go a little bit to close on Tuesday. I mean, put in put in 4 billion shares, $4 billion worth of sells. Oh my God! I mean,
Talk about
what?
the imbalances.
Yeah, you
Yeah.
talk about it. Dennis, I mean, I saw your eyes popping out. Your head coming out of the Skype screen. I mean, what are these guys? What are these guys thinking? Putting out these kind of orders like that. I mean, you don't think they're going to get front run? So could you break that down for us, please?
Well, they did get front run a little bit, okay? And I don't know exactly what went on. I don't know how much of it was ETF related. It was not really what you'd call traditional retail margin selling, because a lot of that would happen by 2:30. Firms would put out, notices to someone and say, look, you got a margin call here, da 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 da. And if the individual doesn't take care of it by 2:30, then the firm deals with it. But they don't want to wait. They don't want to wait to have to deal with it late in the day. Okay? And I'm not completely up on it, but that's my understanding about how the margin works. But I do know that what went on clearly the market was fading. We'd given up half of our gains by 2 o'clock, faded again into 3 o'clock. And really, just the last hour, the last 15 minutes, clearly the market on selling balances kept getting higher and higher. I think by by the time the last one came out, it might have been over $2 billion. But I do know, I was told the following day that there was a very, very large mutual fund, and there were one or two other very large mutual fund sellers also. They were either selling for redemptions or selling because they anticipated redemptions. And I don't know how late in the day, if you're an individual or if you own a mutual fund, I don't know how late in the day you can call up and say, I want to switch $50,000 into cash today and get the 4 o'clock price. It might vary by fund, but I do know that one very, very large fund basically had a ginormous sell-stop order in a huge basket of stocks to be set off if the S&P 500 broke 1920.
Okay.
Now you can go look, and I do know that call got around. So if you go back and look at the chart, I think below 1920 on the S&P 500, whatever time that happened, that's when things got really crazy.
Because that order was going to get executed.
Yeah, as in terms of like a basket market on close.
But these
if
are
the
people
S&P
are
gets below
handling.
1920, I'm selling, $1 billion worth of stock
Right.
MOC.
Tim,
I wonder,
go ahead.
That's a great point.
I mean, what
No,
are
I was
these
just going to say that's a great point.
institutions?
Go ahead, Joel.
What are these institutions thinking? I mean, you have all day to to get.
Look, if they had redemptions, they're not thinking. They're just raising cash, and obviously those sells would not be based on investment decisions. If big institutions have to raise cash, they're going to sell the most liquid, highest price stocks they can, because that's the fastest way to raise cash. And regardless of whether or not they think those stocks are buys or sells. But is it possible? Look, when you say what are they thinking, I've seen portfolio managers in the past make very emotional decisions that you would think only inexperienced retail people would make.
When you see a move and just imagine if you're running money and you see General Electric fall 20%, Pepsi fall 20%, Costco fall 20%, then bounce all the way back, you're scared, your money's gone back, but you might not be making rational decisions at that time because you had a lot of heat you were just suddenly looking at. Now it bounces back. So I don't know, like at that point in time.
Well, the lesson after the fact is that, if you think you want to buy GE at 21, you got to put an order somewhere.
If your order was out there, you would have got executed.
If you think you'd like to buy JP Morgan at 53, you got to put an order somewhere. You're not going to get charged for putting an order out there.
Yeah. So why not have them out there?
And that would help the market because that would add stability to the market. by the time it gets there and bounces back through, and you call your PM or you think about it, you missed it.
All right, we've talked about Monday. We talked about Tuesday. Here we are on Friday. S&P futures are trading above the level that we closed at last Friday. A lot of whipsaws for institutions, for retail investors. What are they thinking now? Here we are. We're back up to Friday's close. Everyone's taking a deep breath here. Some people are calling for the end of the world, the bear market. Other people are calling us to rip back up to new all-time highs. Tim, what's your crystal ball saying?
I don't think we're going to have that. I don't think we're going to have that V, or that continuation of that V bottom. Wasn't even the bottom. That V rally off the lows like we had last October, whereby we made the bottom October 15, 16, and by early November we were at all-time highs again. That was 3 weeks. I just don't think that's going to happen right now. I kind of have thought when we tried to rally on Monday that Friday's lows would be, Friday's lows would be the real resistance area. For a couple days, we had trouble getting through Monday's highs. We got through them on maybe
yesterday.
We got up against them on Wednesday night. We got through them yesterday. The Friday lows are probably a little bit meaningful. I think that there's been a tremendous amount of damage done to the market, and the other thing that's going to hang out there a little bit is that now we're very close to being 4 weeks from the end of the quarter. Second quarter earnings were maybe mediocre at best. How are investors going to react if we get a second consecutive quarter with mediocre earnings and the market's not wildly expensive, but even with what we've had this week, it's still probably 16 and a half times earnings. On the other hand, GDP got a stronger than expected revision yesterday. That's positive for the economy, but I think I think it puts the real possibility of a rate hike in September back on the table, which might have been down to a 10% probability at the lows on Tuesday. So,
lot of different factors. We've been on the line with Tim Anderson. He's the managing director of TJM Investments. Tim, thanks so much for coming on. Great information. We will.
Yeah, I know we kind of went all over the place, but I think that was some of the stuff that not a lot of people have been talking about it.
No,
in the right.
Yeah, no, it's great.
Reference point.
It's great to get an opinion or someone that was there in the trenches. Tim, all right, enjoy your weekend, and we'll bring you.
Hey guys, have a great weekend.
Thanks, Tim.
Thanks, Tim.